Hello everyone. Let's talk today about revaluation of non-current assets. So suppose you recognized the non-current asset. What you're going to do after that? So if you follow the cost model, after recognition of the non-current asset, you carry it at historical cost and perform depreciation every year, and the historical cost will be reduced by the value of accumulated depreciation. And that's it. In some cases, it may happen that the book value, the carrying amount of the asset after you subtracted depreciation, if that book value is bigger than the market value of the asset, you have to do impairment. Impairment is a sort of downward revaluation of the asset. So you can adjust the value of the asset only downwards if you follow the cost model. However, if you follow revaluation model, you of course still recognize the asset at historical cost, and of course you will subtract accumulated depreciation. So you perform depreciation every year, and accumulated depreciation reduces the historical cost. However, you will be allowed to revalue this asset either downwards or upwards. The main idea and the main advantage of revaluation model is that you will be allowed to revalue the asset upwards, whereas with cost model you are not allowed to do this. That's the main difference. You can choose any model you want, but once you choose the model, cost model or revaluation model, you must be consistent and carry the asset using this model. You are not allowed to change every year to a different model. The reason why we need to revalue assets upwards, because the historical cost, historical value of the asset may not be representative and may be misleading, especially if you purchased the asset many years ago. So the building that was purchased in 1965 at $25,000, of course you can carry it for 50 or 60 years at that value, but the market value now of course is much higher, 700,000. So if you follow the cost model, you would be severely underestimating the value of your assets and distorting the statement of financial position. So that's why it is advisable to use revaluation model instead of cost model. Fair value, typically it is the prevailing market price of the asset, if there is market for that asset, of course. The relevant IFRS standard is IFRS number 13. How frequently we need to do revaluations? Whenever the value of the asset is materially different from the carrying value, substantially different. Like in our case, we purchased the building at 25,000, now the market value is 700,000. Clearly the difference is material. If the asset is volatile, the value changing every year upwards or downwards, perhaps some financial asset, or it may be a real estate asset if the real estate prices are changing dramatically, like there is real estate boom, then in this case you may be required to revalue the asset on an annual basis. Otherwise, 3 to 5 years may be acceptable for all other type of assets, non-volatile, non-financial, non-real estate. 3 to 5 years. Okay. Of course, if you have several assets belonging to the same class of assets, then if you revalue one of the assets, then you must revalue all other assets belonging to the same class. So if you have one piece of equipment and you revalue, then you must revalue other pieces of equipment that you have. And the classes are given here: land and buildings, machinery, ships, aircraft, motor vehicles, furniture and fixtures, office equipment. Examples. Then, once you do revaluation, you first need to decide what type of asset is that. Depreciable asset or non-depreciable asset. You know that certain assets like land are not depreciable there in any sense, in accounting or in economic sense. Land is not using its value, it's actually increasing its value over the years. So that's why you do not depreciate the land. However, if you have equipment or buildings, they clearly lose their value over time. So you will depreciate them, and they are depreciable assets. So the methods of revaluation are different depending on what kind of asset you have. The easiest case is when you have non-depreciable asset, because you do not, in this case, you do not have accumulated depreciation, and you don't need to worry what to do with this accumulated depreciation. But if there is depreciable asset, then you need to decide what you're gonna do with accumulated depreciation. In other words, you purchase the asset, then 3 years have passed, the depreciation has accumulated, so now after 3 years you want to revalue this asset. What are you going to do with accumulated depreciation? You have to do something with it. So one of the methods is to restate it proportionately. The other one is to eliminate it altogether. In this course we are considering the second method, elimination of accumulated depreciation. But let's look first at the first method. What you need to do. So the cost of assets is $200,000. The estimated life 5 years, it doesn't matter. You can find annual depreciation. So what is it? It's 200,000 divided by 5 if you use straight line method. So 40,000 per year. So in the first year you depreciate by 40,000, and in the second year you depreciate by another 40,000. So over 2 years you depreciate by 80,000. And so after 2 years you reconsidered the value of that asset, and you think now that the value of these buildings is 300,000. Instead, the fair value, the market value is 300,000 instead of 200,000. So what to do? How you gonna do the revaluation? So first of all, this is historical cost, 200,000. If you subtract accumulated depreciation over 2 years, 80,000, you will get the net carrying amount. Okay, and the upward revaluation is given as the fair value minus net carrying value. Please remember this rule, it's very important. When you do revaluation, you are not revaluing from 200,000 to 300,000. No, you are revaluing from the net carrying value after you subtracted accumulated depreciation. So net carrying value is 120,000, and the new value, fair value, is 300,000. So therefore the value, the increment of revaluation is not 300 minus 200, 100. No, it is 300 minus 120, it is 180,000. So if you use the first method, gross up approach, restatement of depreciation, so what you're gonna do? Look at the table. So this is original cost. This is accumulated depreciation. This is the net carrying amount after you did depreciation for 2 years, 120,000. Now they say that you revalued the asset to 300,000. So 80,000 is 40% of 200,000. 120,000 is 60% of 200,000. This proportion will stay the same. So therefore, if the new value is 300,000, you can find these missing values, because this one is 60% of x. X is therefore 500,000. You can also find the new value of accumulated depreciation, and after that you will subtract 500,000 minus 200,000. This is the entry that you need to make. Then you subtract 200,000 minus 80,000. This is the entry you need to make. And then 300,000 minus 120,000. This is the entry you need to make. And this is your journal entry. Does it make sense? Yes. So obviously 300,000 is bigger than 120. So it is upward revaluation. So the value of your buildings is increasing. Therefore, debit. Right? Then accumulated depreciation account. What is its normal balance? Credit. You know, when you depreciate the asset, you do debit depreciation expense, credit accumulated depreciation. So you put accumulated depreciation as usual in credit, 120,000. And the difference, this is the key point here. The difference is 180,000. We call it a gain on revaluation, but I will mention later on that this gain on revaluation will not be considered as income, and it will not be included in the income statement. You may think that yes, it is gain, so let's put it in income statement, and our profit, net profit, will also be higher, will be up by 180,000. No, not like that. These kind of gains, first of all, it's not operational profit. It's not from operation, it's just from some extra other activities. So therefore you cannot consider it as income, genuine income. So that's why we put it after. So it will be statement of comprehensive income, other comprehensive income. It will include the normal profit from operations, but after you determine this profit from operations, net profit, you will have some extra lines at the end. And that's where you will put gain on revaluation. So it would be put after you determine the net profit. Therefore, you cannot say that this 180,000 belongs to income statement or profit and loss statement. No, it belongs to other statement, this statement, after you determine the net profit, profit from operational activities. And so what have we done here? We just increased everything. We did not remove or get rid of accumulated depreciation. We actually increased it. And we recognize the gain on revaluation, and we increase the value of our asset. That's the first approach. Second approach that we will adopt here. So we have accumulated depreciation over 2 years of 80,000. So let's eliminate it altogether. How do we eliminate it? So if the normal balance of accumulated depreciation is credit, now when we eliminate it, we debit accumulated depreciation. Against what? Against building. So the accumulated depreciation that pertains to this building would be removed, and the value of the buildings is reduced by that same amount of accumulated depreciation. And after that, what will we do? We will, what's the increment of revaluation? 180,000. So let's increase the value of the building by 180,000. So debit buildings 180 and gain on revaluation 180. As with the previous method, this gain on revaluation is not a genuine profit, not genuine income. We don't put it in income statement. We put it after we determined net profit, net income, like that. And that's it. Then these two entries, this entry and this entry, you can collapse, combine, and what can you say? You can say debit accumulated depreciation 80,000, then credit is smaller than debit, so debit buildings 100,000, and credit gain on revaluation 180. I repeat, debit accumulated depreciation 80, debit buildings combination of this 100,000, and credit gain on revaluation 180. So all matches. In terms of total assets reported in the statement of financial position, so both methods, option 2, option 1, give you same result. So what are the general rules about revaluation? So revaluation gains and revaluation losses are treated asymmetrically and differently. Why so? Because in accounting we need to be prudent. So I think I mentioned it somewhere here. Expenses are recorded once they are foreseen. Gains are not recorded until realized. So therefore, if we have, the rule is, if we have loss from revaluation, if it is a downward revaluation, this loss goes directly into income statement and reduces the value of profit and income. However, if you have gain on revaluation, because it is upward revaluation, this gain does not go to income statement, but it goes to statement of other comprehensive income. And this gain will not affect the profit, will not increase the profit. It will be put after you determine the profit. So in other words, losses are affecting the profit negatively, but gains are not affecting profit positively. Okay. Then the rules would be somewhat different if the revaluation is an isolated act, or if this revaluation reverses previous revaluation. What does it mean, reverses previous revaluation? So, for example, you did upward revaluation initially, but then you do downward revaluation that partly reverses previous upward revaluation, or the opposite. You first did downward revaluation, and after that you do upward revaluation that partly or fully, in fact, offsets previous downward revaluation. It's the same here, partly or fully. And the rules would be different. Then the third rule, third rule is actually the first rule. You need to ask yourself, is that asset depreciable or not? And if it is depreciable, then you either use gross-up approach and reinstate accumulated depreciation, but we don't do it in this course. You just eliminate this accumulated depreciation. Then, after you revalued the asset, you still need to do depreciation. It doesn't mean that if you revalue the asset, you can forget about depreciating. No, you will need to do depreciation, but it will be calculated based on the new value of the asset, not the original historical cost. And of course, the number of years will be smaller in your new calculation. So if the asset is has 10-year life, so initially you depreciated using these 10 years. However, if after 4 years you revalue the asset, then after revaluation, you need to depreciate the asset. But how many years will be now left? 6 years. Because 4 years passed already and 6 left. So your new depreciation estimates would be based not on 10 years, but on 6 years remaining. Okay. So, revaluation gains. So, what's the entry? You debit your asset in the statement of financial position and you credit statement of comprehensive income, SOCI, SOCI, let's call it that way, credit. And the name of the account would be Revaluation Reserve or Revaluation Surplus. So every time you see the word Revaluation Reserve or Revaluation Surplus, it means it's not income statement. It is statement of comprehensive income, the section Other Comprehensive Income. So please make sure this is not profit and loss, not income statement. So example, so land, let's start with non-depreciable asset, it's easier. So the land is revalued from 100 to 220. So what's the difference? 120. 220 minus 100, 120. So the journal entries would be debit land, $120, and credit revaluation surplus, revaluation reserve, 120. So it is, it is obviously credit, it's increasing your income, but not the core, not the operation income, other income. But still, the balance should be created in the same way as when you earn the revenue, when you have sales. So the normal balance is credit. The normal balance for asset is, of course, debit. Okay. What about if we revalue non-depreciable asset land from 220 to 200? You see, now it is a downward revaluation. What's the increment? $20. It's actually, not increment, it is decrement. Decrement means it's decrease in the value. So the value of land decreases, so credit. We debit what? Revaluation surplus and reserve? No need. It is a loss, and loss is immediately recognized as loss. And this loss is belonging to the income statement, not to SOCI, not to some other section. No, it is core part of the income statement. So loss, loss of course is not treated same as gain. If gain, the normal balance is credited, but if it's a loss, it is a debit as if it is expense. Right, so the name of the account should not be called revaluation surplus or reserve. It should be called revaluation loss. Okay. Now, let's read this rule. Now we are talking about the consecutive revaluations, specifically initially upward, then downward, or initially downward, then upward. So if an asset carrying amount is increased as a result of revaluation, the increase shall be recognized in SOCI and put as revaluation surplus. However, the increase should be recognized in profit and loss to the extent it reverses previous revaluation. So in other words, let's look at the example. So suppose land initially revalued from 100,000 to 90,000. So devalued, downward revaluation. Decrement is 10,000. So therefore you reduce the value of land, debit revaluation loss. This revaluation loss is a loss that goes directly into the income statement. Okay, so that was in year 1. Now year 2. Now we are revaluing upward to 120,000. From what value do we revalue? From 100 or from 90? From 90. So initially it was 100, then 90, and then up to 120. So now for the second entry, we start with 90. From 90 to 120. What's the value of increment from 90 to 120? 30. 30. But this 30 will be split between revaluation gain and revaluation surplus. Yes, we increase the value of land by 30,000 from 90 to 120. But when you move from 90 first to 100, you are reversing original decrement. So you see, originally we had decrease of 10,000. Now from 90,000 up to 120, you first reverse the original decrease of 10. And this reversal is not a genuine increase. It's just a reversal. The genuine increase would be from 100 to 120. What do we do with genuine increase? As always, any genuine appreciations or upward revaluations, any genuine gains are not put in the income statement. They are put in SOCI. So therefore, this genuine one from 100 to 120 is not put in the income statement. It is put in other comprehensive income. And what about the reversal? 100 to 90 and then from 90 back to 100. This reversal would be put in the income statement, in the profit and loss statement, under the heading of revaluation gain. This is a gain that affects profit and loss and calculation of profit and income. But this genuine increase does not affect profit and income. It goes into the separate section under the heading of revaluation loss. So see, we treat things asymmetrically. If there is downward revaluation and if it is a loss, it goes directly into income statement. But if there is a genuine gain, like here of 20,000, it does not go to the income statement. It goes into other comprehensive income. And of course, if it was isolated revaluation just from 90 to 120, then clearly debit land 30 and credit revaluation surplus again this genuine increase of 30,000. Suppose there was no previous decrease from 100 to 90, just from 90 to 120. That's a genuine increase. A genuine increase again does not go to profit and loss income statement. It goes into other comprehensive income. It will not, this 30,000 will not affect our profit and loss and income, net income. Okay. And now let's look at other example, the opposite. See, in previous example, we first devalued and then revalue. Now what we do, we first revalue and then devalue. So initially increase from 100 to 120 and then from 120 down to 90. So first revaluation from 100 to 120 is increase of 20,000. Of course, it goes to the other comprehensive income, not affecting our net profit and income statement. And the value of land, of course, increases. Now, In the second year, we start with 120 and decrease to 90. So the decrement would be 30,000. But this 30,000 again must be split into genuine decrease and reversal. So what is our genuine decrease? The genuine decrease would be from 100 to 90. And that genuine decrease here must be put, genuine loss, it is put into the profit and loss statement. So you see, genuine gains do not go to profit and loss statement, income statement, but genuine losses like here, they do. That's why I put profit and loss. And the other 20,000, it is a reversal. Why is it reversal? Because initially it was from 100 to 120, and now it is from 120 back to 100 and then further to 90. So this from 120 to 100 is just a reversal. And reversal, we put it in the statement of other comprehensive income. Since it is a decrease, so obviously revaluation surplus cannot be credited. It would be debited. In general, when you think about this gains, losses, and surpluses, what is credited, what is debited, just assume that gain is treated as if it is a revenue, and loss, it is treated as if it is expense. Of course, not revenue and expense, but as if. And so here it is decrease of 20,000, so it's treated in the same way as if we treated expense debit, right? And if it is increase in something due to revaluation, then we treat it as if it was a revenue. Okay, what if it was just decreased from 120 to 90? Then the value of land decreases, credit land, and there is revaluation loss. It's a genuine one. It goes into profit and loss and income statement. Put here P&L or income statement, and it is debited as if it is expense. Okay. And another example, so land is revalued upwards and then downwards. The revaluations are consecutive, not isolated. So initially it is increase, and increase must be put in statement of other comprehensive income as revaluation surplus or revaluation reserve. The value of land is increasing. So then from 1.2 million we decrease to 800,000. So the decrement is 400,000, and this 400,000, so we put it here, land is decreasing by 400,000 credited. This 400,000 must be split into genuine or non-genuine. So the genuine loss would be 200,000. Call it revaluation loss. Loss on revaluation goes into the profit and loss, decreases your income. And non-genuine, this one is a reversal of initial increase of 200,000. So this value corresponds to 1.2 million minus 1 million, back to 1 million. Okay. And similar example here, land is initially revalued upwards and then downwards. So initially the increment is 50,000. The increment is not affecting income statement, it affects as OCI, that's why you put it as credit revaluation surplus. And then from 550,000, the decrement is to 400,000. The difference is 150,000. Yes, the land is credited by 150,000, but from 550 to 500 is a reversal, and from 500 to 400 it's a genuine decrease. And genuine decrease, obviously, from 500 to 400 is 100,000. Genuine decrease affects your income statement, reduces your income, but the reversal is just a reversal. It does not go to the income statement. So let's stop for the time being.